Fund Supermart, your online gateway to unit trusts.
So starting off with the next presentation is Ms. Carol Lai. She's from Legg Global Asset Management. Her topic today is Unconstrained Fixed Income Investing in Ever-Changing World. Let's welcome Carol on stage, please.
Hi, everyone. Hi. Thank you for being here today. I'm Carol, and I'm the Regional Portfolio Manager for Brandywine Global, which is an affiliate under Legg. So, just to really get into the heart of this, who is Legg? You must be wondering, yeah, you probably saw their booth outside. Legg is basically a multi-affiliate. They own a couple of affiliates, including Brandywine. They have Roy's, they have QS, they have Western. So it ranges from equities to fixed income. The AUM that they manage is 750 billion. So this is a very big company, and they own us. And then very quickly, you have probably not heard of Brandywine Global. We don't sell brandy, we don't sell wine either. We are a fixed income, which is bond. It's a bond manager, largely because 3/4 of our AUM is in bonds. You can see it's fixed income, about $54 billion. Our total AUM of the firm is about $70 billion, and we are actually headquartered in Philadelphia, US. We have a Singapore office, and that's where I sit. I look at Asian markets for them, and I've been with the firm for 8 years. The firm in Singapore has been around for 13 years. A lot of our clients in Asia and worldwide are basically pension funds, sovereign wealth funds, central banks, basically institutional clients, and then Legg helps us to distribute our funds out to you guys, to the retail market. And that's possibly why you don't really hear very much about us. As you can see, about 15 billion of that whole AUM that we're talking about, of that whole 70 billion AUM, is coming from Asia, including Japan. Okay, so just the next slide about a little bit more about why Brandywine. You must be wondering, a bit more, not just about our AUM and, the usual stuff. But our firm has been around since 1986. We are a value firm, and we do a lot of analysis on whatever we do. So we do have the equities strategies, but as I said, fixed income strategies is 3/4. We have maintained our core philosophy and the way we invest ever since the strategy started out. So for the fixed income strategy that I'm showing you, our strategy has actually started since 1992 with the main portfolio manager called Steve Smith and David Hoffman. They have been around since the very start of the strategy. So altogether, they actually have 30 over years of experience investing in global bonds. The second thing I will point out is we are actually a top-down macro fund. So we look at the whole world from what we call a 16,000 feet high level. So we look at various regions, we use our models, we filter out countries, themes that we think are likely to outperform or would likely play out in the next year, in the next couple of years. And that links us to point number 4. It's really a long-term focus. When we buy a currency and a bond, we are not speculators. We don't buy it just for 3 months and then we sell it out. For us, any trade would be 6 months to maybe 3 years, 4 years. It really depends on the country fundamentals. The third thing, in Brandywine, we are not afraid to be contrarian to the market. Sometimes people will think that, well, it sounds like you guys are, being a bit too bullish or a bit too bearish, but, that's how you make money. To make money, you have to be contrarian. You cannot just follow the crowd, because one day the tipping point will come, and you're going to be all caught in that whole trade, and how you're going to get out. So for us, we are not afraid to be contrarian. Why? And that links us to number 5, because we have seasoned investment professionals. Steve and David, the 2 portfolio managers, have been around. They have 30 to 35 years of experience. Another one of our portfolio managers have been with us since 1998. So the actual team has not been, they have been together since the start of time. And for myself, I have been with Brandywine for 8 years. So you can tell our turnover of staff is actually pretty low. Okay, so just to touch a little bit about, global markets. What is really the outlook? What is the view? I'm sure in your earlier sections, probably people will have talked about it as well. At Brandywine, we are looking at it as what we term the beginning of the end. And what does the end mean? The end is really what we call financial repression. If you can remember, since the start of the financial crisis in 2008 till now, obviously all of us know that rates have been very low. It has just gone down further, lower and lower, and that is really because the central banks was pumping a lot of money into the financial markets, to the world, to prop up growth, okay? But to us, that has come really to the end. And that's why it's called the beginning of the end, which also shows that it is really a structural change that we are going to see forward. Be it whether in growth or inflation, those 2 things are changing. Okay, so let's just look at one theme that is very central in our portfolios now. It's called global reflation. So as you can tell, if you remember last year, when we came into last year, China, had problems with their currency. There's a lot of capital outflows. People were very worried about China. And then China came along and just did their fiscal stimulus. So that kind of propped up the world. And we started to see signs of this whole global deceleration. So not only China started doing fiscal stimulus, they were the first ones who started it. Subsequently, you started to see, a lot of governments saying, I need to do fiscal stimulus. And that's where you get the Trump thing. If you remember last year, again, he came in, he got, he'll be inaugurated on 20th of January. And that really pushed equity markets up. And basically, that's what we call the secular stagnation is finally over. And what we're also seeing is that there's a lot of deleveraging. The cycle of deleveraging has ended. So again, pointing back to 2008, if you remember, America went through that whole great deleveraging of the housing market. If you look at the charts again today, it's really the opposite. The consumers are all re-leveraging back. Housing market is booming and things like that. So we are no longer seeing deleveraging, no more deflation, and there is a consolidation, no more consolidation in global excess capacity. And that's really coming from China. Because if you remember, China was, they had problems with their coal, steel plants and everything. But China has tried to reform that, take out the global excess supply and things like that. And that's why you start to see commodities having had rallied quite a bit in the past year. So important thing is, since global, what we call PMIs, which is purchasing managers index is growing, and you have got higher commodity prices, the question this year is really, will it continue? And I think that's what everybody's interested about. And that's actually very highly linked to China. Because we know that in the US, Trump is coming in. He is promising some policies, and that will come in. We are a bit skeptical of when the policies will come in. We do think it will be in the later half to next year, and that's why we do feel that some of the equity markets have actually run ahead of itself. It's the same with the currencies as well. A lot of good things have been priced into global growth. So the question is, US looks like it will continue on that, but how about China? The big question mark is actually really China, because we do see that there is some slowing down in the money that is flowing around in China. If you think, if you got money that's slowing down in China, really what we call money supply, then it also means that perhaps in the second half of this year, China will slow. It could happen. Of course, they are holding a very important committee meeting in which Xi Jinping will then replace, if you remember, there are 7 standing committee, they will replace perhaps even the Prime Minister. So we do feel that before that, growth will still be fine, but after that, no one can tell. And then the next thing, which I talked about earlier, central bank policy. Basically, global monetary policy basically lost its mojo. Fiscal stimulus will be the next thing in town. And then you have, why did that happen? It's really, you can see it was really because of the populist mentality that is growing in the world. And that's really the frustration with income inequality. That is happening in the US, look at the blue-collar workers when UK voted for Brexit as well. So I think the governments are waking up. You can't just rely on monetary policy, you have to do fiscal stimulus. And what does that mean? That means that perhaps this global reflation story can actually carry on for a while more. What does that mean for inflation then? Inflation could continue to pick up. There might be rising bond yields as well, and things like that. Because also when you have fiscal stimulus, these countries will actually issue more bonds, and then the bond prices might fall. So what is our outlook, on global bonds and the US dollar? To us, the US dollar went, and I'll show you later, a ranking of all our currencies that we use a model to rank. And what we always look at is whether is a currency over or undervalued. It's very important to know where it is on a valuation scale, because you don't want to be really in a currency that is overvalued. Although nonetheless, sometimes an overvalued currency, an overvalued asset can continue on being overvalued, but one day it will reach a tipping point. So for example, the US dollar is actually overvalued, and it's actually indicating that all this Trump, US good growth is all getting priced in. And in addition to that, as I said earlier, overvalued currencies can continue being overvalued. So for the US dollar, if you've got what we call animal spirits supercharging the economy, you can end up with a higher US dollar. But you also have to think back, does Trump really want a strong US dollar? I don't think so, and we don't think so. Why? Because the people who voted for him are the people who lost jobs in the manufacturing sector. If you want your jobs back in the manufacturing sector is actually very dependent on the dollar, on the US dollar, which means Trump will not actually entertain a very strong US dollar. So which is why we do think that, yes, the US dollar, it is a dangerous thing this year. It could go up 5% or so. But we do think that it will reach a tipping point where, basically the US dollar cannot rise as much as, what people are saying out there. The other thing that we notice about global bonds as well is that we ourselves, we don't like developed market bonds. So for example, we had been selling some of our US treasuries, we had been bringing down that weight, and we had been buying into other countries' bonds. For example, in the emerging markets, some of the bond yields, and we rank them according to real yields, the bond yields are very good. It's paying, for example, in Brazil, it's paying you 11%. And inflation is coming down. So for certain countries, and that's where we do our analysis on each individual country to look at where best to place the money. So in that sense, I would say for global bonds, we don't like the developed markets. We instead like the emerging markets, and we do think that perhaps, for US treasuries, it could go up a bit more, although at 3% for the 10-year yield, might be a bit too expensive, and then what can happen, it will actually strangle US growth, because if you remember, a country's growth is also very dependent on interest rates. So if the interest rates rise too much, it will squeeze out growth, and then you have a downturn, and then that's when interest rates will come down again. So if bond yields in US were to rise too high, currently the US 10-year bond yields are trading about 2.3%, But we suspect if it goes to 3%, the US economy might not be able to sustain that. So, really linking that, where are the opportunities? Number one, we do not like developed market bonds in portfolios that we can do unconstrained, which is what I'm talking about today, unconstrained fixed income investing. We are actually short those developed market bonds, and then we buy the emerging market bonds or the developing market bonds, those countries that are facing falling inflation, and yet you have rising growth. So some of the risks that we see ahead, in this year is really number one, China growth. We are looking at China growth quite closely. The other thing is that, if Trump and the US was to put up trade protectionism, it wouldn't do good for anybody in the world. Can you imagine if Trump said, I'm going to put 45% taxes on China goods? China is not going to sit back and do nothing. They are going to come back and say, I'm going to tax your goods 45% too. And who loses at the end? All of us, because we are consumers. We have to pay more, basically. So that's not very good for everyone. The next thing that we worry about as well is European elections. If you remember, we've got French, German elections. Germany is the stronghold of Europe. If there is rising populism in Europe, that is very worrying, because down the road it might mean that the Eurozone might break up or something like that. Although that is a very long-term consequence, but it is still worrying if that trend is increasing. The last thing is animal spirits really supercharging the US dollar, because emerging markets are dependent on a weaker US dollar, or at least a US dollar that's not too strong. Because if you got a very strong US dollar, basically some of the emerging market currencies will then have to be even weaker. So that's what we are worried about. But nonetheless, there are those opportunities this year. So just to talk about why global bonds. If you say, yeah, this year is going to be a year of equities, growth, we should just buy into equities. But really, should we really do that? You need to think about what we call asset diversification. So we have this calendar chart. I suspect you might not be able to see it very clearly from your side. So I'll just read to you. For example, in 2014 and 2013, 2015, the best performing was US equities. And then the previous year before, it was gold. And in 2016, it's global high yield bonds. But the question is, are you really able to pick every of these bonds or currencies or equities every year, year in, year out? Some people can, some people cannot. So what we always advise clients to do is always to have a diversified portfolio where you have got bonds and equities together, so it stabilizes your portfolio. When we talk about the global bonds, we are also looking at a lot of risk this year, as you can tell. I was talking a lot about China risk and Europe risk and things like that. So which is why you kind of want to have some bonds in your portfolio sometimes. So the next question is, why unconstrained? I'm not sure how many people have heard of this word unconstrained. It allows, as a portfolio manager, as a manager, to provide income while shielding from rising or falling interest rates. So if you remember, 8 years, we had good years of lower interest rates. Bonds were doing not too bad. And then now we'll have rising rates. So for us managers, we can take advantage of that too. Because like I said earlier, we don't like developed market bonds. So we can short the bonds and go along with the bonds that have higher yields in the emerging markets, and we put them together in a portfolio, and that helps performance. The next thing is that, with skilled managers like us, we can add value with various sectors and countries. If you see, on the left-hand side chart, basically this chart is really saying, the range of returns between government and corporates and mortgages just in a US country, in US where, you can trade a lot of corporate mortgages. Well, you look at the returns are between 0 and 10%. But when you look at across countries, you can see that, for example, South Africa was the best performing currency and bond last year. You can get 30% out of that. So, and what you want to avoid is really all these countries at the bottom and be long in the countries on top. So that's basically our job. That's what we do. We try to pick the outperformers, and we try to miss out on these underperformers. So when we look at, why do we pick different countries? Some people would say, oh, I can just buy US bonds, But we don't believe so, because each different country business cycle will actually drive your the investment decisions. So, for example, when there is an improvement in the business cycle, inflation is low, and then your profits are starting to increase, then of course you want to be, say for example, you want to, have a bit more corporate bonds, maybe some equities. When you have, say, for example, expansion, very high expansion, you want to be in the higher quality of the corporate bonds, and then you want to be, say for example, long certain currencies as well. And then when there is a slowdown, you want to hedge out the currency. You probably want to go into some of the US treasuries or bonds of the country, and then you go into recession. So really, it's a business cycle that guides this whole investing. And because it's unconstrained, we can either buy or sell, long or short, that bond or that currency. So for example, again, this really links back to the previous chart where we talked about, we can buy the country, we can buy the currency, we can buy the sector as well, depending on what part of the curve the country is in terms of its business cycle. So this is what we call the Legg Brandywine Global Fixed Income Absolute Return, because this fund basically gives the flexibility to be long and short certain currencies and bonds. So coming back again, earlier I told you that we actually use models to rank all our currencies and bonds and countries. So for example, for the countries, we are actually in this fund long, for example, Indonesia, Brazil, Poland, Mexico, South Africa, the Indian rupee, the New Zealand bonds as well. We have some Malaysian bonds as well. You might be wondering why I didn't mention Turkey. So it doesn't mean that we rank this and we just close our eyes and we say, okay, it looks cheap, so we'll buy it. It doesn't happen that way, because sometimes there might be certain reasons for why a certain thing is cheap, right? So for example, Turkey, we don't think it is that cheap yet. So they have got really quite a bit of political problems there, and we don't really like the way that President Erdogan is conducting all that politics stuff in there. So we feel very uncomfortable. So we don't buy Turkey. And on the other hand, in this fund, we would then want to be short, for example, the German bonds. And we have actually reduced the weight of our US bonds as well, because really the yields are so low, it's like negative yields. Why would you give your money to a government and receive nothing in return? That's really silly, right? So that's what we do in this portfolio. And on the other hand, we also buy the currencies. Again, you see on the left-hand side, sorry, this red pointer is a bit disappearing. Okay, here. Turkish lira, again, like I said, is the cheapest currency, but no, we are not going to buy that. The British pound, a very interesting one. Most people out there will say, I don't like the British pound, it's the dumpiest currency. But for us, if you remember, we are contrarian. This currency, it is very cheap. We have put in about 10% into the portfolio for the British pound. Why? We think, Brexit has it's going to come about. But ultimately, in the medium term, 3 years out from now, Britain will actually be probably better off on their own than with the Eurozone. The Eurozone takes a long time to negotiate any trade agreement with any country. They've got tons of regulations. So Britain, being on its own, will quickly be able to negotiate deals with US, with Asia, with China, get all that FDIs, get all the investment going into UK and really restart their economy. We are also seeing a lot of fiscal stimulus that is going to come out in UK, and at the same time, they're still holding their interest rates very low. So that really results in a lot of growth impetus that could happen in about a year or 2 to 3 years. So it is going to be a bit of a long-term trade. You kind of have to sit in with this, but the British pound actually looks very interesting. And then we have various other currencies, for example, the Swedish krona, the Mexican peso, and we tend to be long all these currencies. We buy these currencies that are undervalued, and then we want to avoid these currencies over here. So if you remember just now I said the US dollar over here, it is actually the most expensive currency. So you kind of have to be careful with the US dollar. So, just basically very quickly on this portfolio, it's really you can long short currency, and we can buy investment grade corporates, mortgages, and our credit quality is very good. It's actually A rated. These are the returns on the fund. So when we look at the 3-year return, and since inception is about 2%, that actually beats our benchmark for this is really a LIBOR benchmark, which is basically a cash benchmark. So we have return since inception, which is 2012, is 2% per year. This is cumulative returns. If you look at it from here to here, that's the returns. The next fund that's actually very interesting is what we call the Global Income Optimizer Fund. It's called Optimizer and it's called Income because it's, as the name tells, it's income. And what we are really saying here is that this fund is able to buy into sovereign bonds, corporates, high yield, emerging market debt, bank loans. It seeks to deliver high income. It's a multi-sector opportunity set that I said just now. It has risk management as well. So, for example, during the Trump election, what the portfolio managers did was actually to hedge out all the portfolio with some derivatives and kind of kept the investment returns that they had in the past 1 year. At that time, it was about 8 to 10% already. And what they did was to not be exposed to the Trump effect. And then after Trump, they then loaded up, took off the hedges, what we call a hedging. And now, and as of last year, they ended the year with 12% returns, which is pretty good if you're talking about bonds here. The payout, the dividend on this is 5.2% every quarter. So, it's 5.2% over the year, and it paid out over every quarter. So that's pretty good for dividend payout. And you are looking at, these are the returns. So year to date, as of last year, as I said, it's 12%. In the 3 years, it's 3%. Since inception, again, 2012 is 4%. So this fund has done phenomenally quite well. And I would say, looking at the cycle of where things are going, if Trump is going to be successful, we do see, a lot of growth stimulus and things like that coming out, perhaps in 2008. This fund will probably be the one that's positioned for it. Why so? Because they are able to buy in what we call lower quality credits, having done all the analysis and things like that. And we are actually also seeing a lowering down of default rates of corporates. So if you remember, if the cycle is good, the business cycle is getting better, then you are going to have lower default rates in the country. And when we buy, say, for example, the lower quality credits, those credits will definitely benefit. And the good thing about this fund is that when we go into a downturn, the portfolio managers are able to use the tools available, which is really the derivatives and the sovereign bonds, to kind of shift the positioning of the portfolio from being aggressive to defensive. So that is the beauty of this portfolio. You can see cumulative return 15% since the inception. This is the graph here. So I'll just quickly summarize because the time is up. So why global bonds? We believe that global bonds do give a balanced portfolio to have more stable returns. In a portfolio, your returns won't be so volatile. Unconstrained bond gives you the income, while we as portfolio managers are able to give you the returns and be defensive at the same time when we need to be defensive. And we can do really asset allocation across the entire fixed income space. So we're able to find, across the whole field where best to give you the returns. And why Brandywine again? Well, we have 30 over years of experience for our portfolio managers, and we take a very active and flexible approach to fixed income investing depending on the economic conditions. So that's it. Thank you, everyone.